Okay, that is Arundhati Bhattacharya talking about the SBI merger with some of the associate banks. What's SBI up to? Well, currently at 294. Well, let's focus in on our discussion for the day. An interesting report from S&P on the oil marketing companies talking about how they will be stepping up investments in upgrading refineries and fuel price reforms are expected to continue. Vishal Kulkarni is the Associate Director, Corporate Ratings is S&P Global. He now joins in. Vishal, just taking a look at your report, let's talk about some of the key factors and key points that you all have highlighted. Capex, I mean, you're seeing higher profits as fuel prices are market linked. Walk us through what exactly is the rationale, and if you could just elaborate on which companies you think will stand out on higher profits.
Absolutely, and good afternoon, everyone. So S&P published this report a week or 2 weeks back, which focuses on the government-owned oil and gas companies primarily, which includes your oil marketing companies, HPCL, BPCL, IOC, and also looks at the upstream companies, ONGC, Oil India Limited, and some of the gas infrastructure companies, primarily Gas Authority of India, GAIL. So the theme of the report focuses on how these companies have performed, especially last 2 to 3 years, since Modi government the diesel prices were market-linked since end of 2014 and has also shown commitment to reduce the subsidy burden on the LPG cylinders that they distribute and the kerosene fuel that distribute. So since this market-linked pricing has come in, what we have seen is the subsidy burden has come down, which means the government has to pay less subsidy. The upstream oil companies has to pay less subsidies, and hence the financial profile of ONGC and oil has generally been better even through the low oil price environment that we see today. The oil marketing companies, which used to receive a lot of a good amount of subsidies, which otherwise they used to fund through a short-term debt, has less and less dependent on the subsidies, and hence the debt on their books has gone down. So overall, as a summary, the financial profile of these companies has improved a lot. Just a pointer can be the debt to EBITDA profile for the oil marketing companies used to be more like 5x or 5 times 3 years back. Now it has come down to 2.5 to 3 times, which is a significant improvement. Now the key question is whether they will use this newfound financial strength, the financial flexibility to invest in future. And that's an important question because these companies, the oil marketing companies, have to invest in the refinery asset base.
Right.
They have to increase the capacity, upgrade the capabilities, and cater for the future needs.
Okay, Vishal, do you think that their credit profile has improved in a meaningful manner with cash flows picking up, and that's all got to do with crude prices stabilizing? And if that's the case, would you say that the investment case for oil marketing companies has improved?
So the reforms, which again goes back to market-linked pricing for diesel, reducing the LPG and kerosene subsidy burden, that is probably one of the key and most important factor for the improvement in the financial health of these oil marketing companies. Implicitly saying that the reform that government has put in has sustained over last 2 to 3 years because of the low oil prices. But even if we expect the oil prices to go up, let's say $5 to $10 higher every year, the ability of the government to kind of sustain the reforms the way they are to keep the fuel prices market linked is fairly reasonable expectation at this point. And with that, we believe the financial health that these companies have garnered throughout this last 2 3 years is sustainable to our view.
Just stay on with us, Vishal. I want to take a moment to address another stock that's really doing wonders in today's session, and that would have to be Wockhardt. In fact, we had the management talking with us exclusively on ETNow about what really the overall profile of certain drugs and approvals means for the company, and that stock is holding out very well in today's session. In fact, as we speak, Wockhardt has surged very smartly, and now it's currently quoting at the highest point of the day. That's Wockhardt for you currently at 761 and counting. But Vishal, to get back to our discussion, let's talk a little bit about, do you see the leverage perhaps for some of these oil marketing companies worsen if the capex needs are elevated, which in all likelihood will take place?
So yes, the financial profile that we will see for these companies may not be as strong as that we see them to have today. That's again because the capex plan that they have publicly announced or publicly stated are much higher than what they have done in last 5 years. Let's say comparison point is they have spent about the three oil marketing companies I'm speaking about have spent about 1.6 trillion rupees. Let's say 20 to 24 billion dollars over the last 5 years. What they want to spend is about $50 billion over the next 5 years. That's like twofold jump in the capex plan that they have. Now, if they jump to that kind of level of investment immediately, and the benefit of which in terms of the future cash flows are going to come only in, let's say, 3 to 5 years when these new refineries are ready and they can ramp up the capacities to the expectations that they to their capacities. Then
Sure.
we could see some deterioration in their financial profile for a period. But
Right.
but assuming that twofold jump right away in the capacity in the capital expenditure is unlikely. If at
Okay.
all, it will happen gradually.
Great, Vishal. Thanks for joining in and giving us some insights on that report, S&P on the oil marketing companies. Let's take a quick break right here on the show and stay with us as we focus in on the top mid-cap pick for the week as well as some more stocks